something. From all these OMO auctions, the longer dated instruments always get oversubscribed, whilst the shorter dated instruments get undersubscribed. So you see investors keying into longer dated instruments. So for these bonds auctions, what we expect that there'll still be a lot of interest, local participants from local players, of course, the PFAs and other big institutional investors. Even the expectation for February T-bills auction as well is that it would remain oversubscribed. More interest would be in the longer dated T-bills instrument, the 364 days instrument as well. So investors are beginning to key into longer dated money market instruments than shorter dated money market instruments.
As can be seen from yesterday's auction results for the Nigeria Treasury bills, where we saw mostly the 364-day being oversubscribed by investors, followed by, of course, the 182 with 17.24%, and that will most likely continue for the first half of the year.
Yeah, for the first half of the year, you know, a lot of market performance will be determined by, as we said in our outlook, the reforms that the monetary policy operators and the fiscal policy operators carry out this year. But if things remain, if status quo remains on the policies and the performance of the management, then we'll still see investors rush into fixed income instruments as a safe haven, of course.
Of course, that's been what's applied in most cases in the market. For the most of 2016, that's what we saw, and you're also expecting that to happen in 2017
we expect that to continue. We expect that to continue. We're overweight on fixed income anyway than equities as an investment strategy.
All right, but just give us your picks, your top picks, at least for the FGN bonds. Which do you think investors will be favoring more as we go into February fully?
Investors look at the benchmark bonds. From last month's bonds auction, you see investors, there's a renewed appetite in the March 2036 instrument. I think there's a 20-year bond. There's a renewed appetite. Again, all this is predicated on expectation of reduced rates. So investors are trying to key in on the long term. We see investors keying into medium to long dated bonds, you know, to hedge against falling interest rates or expectation of weaker interest rates or weaker yields. And
of course, the currencies market is still very forefront on all of the issues and the investment decisions that they will be taking.
Yeah, all eyes on the MPC and the CBN. You know what they do about FX challenges. The CBN has come out to say that there are no issues, right? They don't know why people are quoting different rates from parallel markets and BDCs. So I think the major problem is even that they don't even appreciate that that's an issue, right?
No, they do. If they didn't appreciate it, I don't think they would talk about it, Ibrahim.
It's one thing to just talk about it without having any actionable plans, right? We can talk about it tomorrow, and the situation remains the same. But until as everybody, I'm sure all the guests that come on your show say the same thing. Until until the problems in the FX markets are addressed properly, then we'll still see a domino effect on the performance of the equities market and the fixed income markets, of course.
Ibrahim, before I let you go, what's your outlook for lending rates for the rest of the year?
For lending rates for the rest of the year, it probably still remain around the current levels. Benchmark lending rates.
Did I say lending?
NPR.
Sorry, interest rates.
NPR.
Interest rate, yes.
NPR. I know. I got
Sorry.
that. I got that. For the first month, as you know, our expectation last month, MPC was that they were going to retain NPR. The challenge would be when inflation rate starts moderating, you know, on the back of the high base effect from last year, and if the MPC is trying to channel it against inflation rates, then they'll have to start reducing. But right now, we expect that benchmark lending rates will remain at current levels.
All right. Ibrahim Babalola, investment research analyst with AfriInvest. Thank you so much for joining me on the program.
You're very welcome,
today.
Maria.
So we're turning our attention to another segment of the market. That's equities, Nigeria equities, in just a moment. Join us again. Welcome back. You're watching Business Morning on Channels Television. Oluwashino Olubo, who is the head of research at GDL Assets, joins me now on the program. A good morning to you, Oluwashino. It's great to have you on the show.
Good morning, Harry. How are you today?
Very well, thank you. So talk to us a little bit about what's going on in the markets. Of course, more results are coming in, even though in trickles, but it's enough to hold investors' attention very rapt, even though they've been expecting most of those numbers to come in. Have you been surprised by any of the numbers that have come into the market?
Not exactly. I've not been surprised by any of the numbers in the market because the stock market is supposed to reflect what happens in the overall economy, by the way. And then the majority of the companies are only exhibiting the overall performance of the economy, where the macroeconomic indices have been very weak. And that's why you see that some of the companies, they've recorded growth in their revenue. And despite the growth in their revenue, you see them recording reduction in the they turned out. That's because of the rising costs in the economy generally, and the reduction in the household demand and overall aggregate demand of the economy. So no surprises just yet, because we expected mixed outcome.
For you, which in particular strikes you? For the consumer goods, notice yesterday, which was the first trading day of the month of February, almost seems as if it is a start of what we should be expecting for the rest of the month, especially as very lackluster numbers come in. Review for us how January was for the equities market.
Please say that again. I could barely hear you.
Okay. Yesterday was the first trading day for the month of February, and we had very lackluster numbers, of course, coming in because of investors' response to some of those results coming into the Nigerian Stock Exchange. Review for us how January was for the equities market.
Well, for equities market, the current law that we have is likely to continue for a bit. One, because of the overall performance of the economy. Two, because of the attractiveness of the fixed income. There's hardly anywhere in the world where you can have the yield that ranges between 16% to 18% as we speak. So that is kind of attractive. So instead of bringing money into equities and taking the money, I'd rather we go for fixed income where T-bills ranges as high as that. Then the weak fundamentals in terms of inflation rate that is very high. You have the economy recording negative growth. You have the stock foreign exchange that has been very, very unstable. Then you have a weaker strength of the state government to pay salaries. All of these things are the reason why the confidence is low, and of course we have the tepid participation of the foreign investors, which are altogether impacted on the numbers that we are having on the equities market. However, I feel that going forward, we might start experiencing some improvement because I expect banks to churn out better results as a result of the growth and the profit that they had on their foreign exchange, and renewed effort on the part of the fiscal authorities to rescue the economy. We've seen the vice president going about trying to rescue the economy by doing some things that we feel that they are positive, amongst other things. Then on the part of the macroeconomic index, we have seen tremendous improvement, or somewhat improvement in the reserve, that's around $28 billion, if you like.
All right, so Oluwashino, thank you so much for joining us on the program today, and of course sharing your thoughts with us. Oluwashino joins us on the program. He's the head of research at GDL. Thank you so much for your perspectives. And that's it on today's edition of the program. Many thanks for staying with us. I'm Harriet Agmi. Have a profitable day.